After sitting at a high of 4% from September 2023 to June 2024, interest rates on euros have been dropping quickly, with the ECB now lowering rates all the way to 2.25% per year. This has been going on because inflation has been somewhat under control in the Eurozone right now, sitting at an average of 2.2% over the past year according to Eurostat, and to boost the Eurozone's weak GDP growth numbers. Now, I would love to sit here and tell you that rate cuts are done and that we can at least enjoy 2.25% on a euro savings for a while. But sadly, the next ECB interest rate meetings are not that far off, and we may be looking at rates as low as 1.75% per year, as soon as Q3 this year, according to a recent survey of monetary analysts. So yeah, sadly it seems like the comparatively high interest rate environment in the Eurozone is coming to an end soon. Which is likely great for those that are looking to borrow money to build a house, for example, but not so great for anyone that's simply trying to earn some interest on cash without taking on investment risk, like the market going from plus 1% down to minus 10% within a single month as we've just experienced. Which brings me to today's topic. Is the German bank Trade Republic, which my wife and I have been using for the past 2+ years to easily earn the ECB interest rate on our cash reserves, still worth it in the current environment? Or is it worth looking at other options like money market ETFs, bonds in euros, or even other currencies like the dollar, where rates are still significantly higher at 4.25% per year? So let's take a closer look and compare some of the options that are out there right now, and finish things off with what I'm planning on doing going forward myself. Before we dive into the alternatives, let's take a quick look at where we stand right now with Trade Republic. In case you're new, Trade Republic is a strictly regulated German bank and broker with over 100 billion euros in assets under management that started passing on the ECB interest rate banks get for short-term cash deposits as early as January 2023, when it was still at 2%. They then raised this rate to 4% in line with the central bank in September 2023 and continued passing on what the ECB pays banks at its deposit facility over time, which as of today is 2.25% per year. All of this without any fees and without any lock-in, which means you're able to withdraw your money at any time. And the added benefit that you're able to directly invest some money that's already sitting there when there are opportunities like a market correction. That's why my wife and I have been using them almost exclusively to earn interest on our own cash reserves, which are made up of our emergency fund as well as cash I need to put aside for upcoming tax and social insurance payments since I'm self-employed. Since security is essential when we're talking about emergency funds or money that's not meant to be invested, for example because you're planning a large purchase in the near future, here's what you need to know. For Trade Republic users based in most countries right now, you're simply earning interest on up to 50,000 euros of uninvested euros, and your money is secured by 100,000 euro bank deposit guarantee. While if you're based in Germany, Italy, France and Austria as well as of today, you're able to earn interest on an unlimited amount of uninvested euros with some of your money sitting at partner banks, each with a 100,000 euro bank deposit guarantee and some of it in a money market fund. Right now, that's the BlackRock ICS Euro Liquidity Fund that's in the lowest possible risk category, which closely mirrors the ECB rate at the moment. Your money within a money market fund is completely segregated from Trade Republic, which means it's fully protected and can be touched in case of bankruptcy, no matter the amount, just like with stocks or ETFs. Since Trade Republic isn't able to infinitely scale the amount its partner banks are willing to pay the ECB interest rate on, this is an efficient way to solve that problem while at the same time ensuring any amount above the default 100,000 euro bank deposit guarantee is protected as well. You're always able to see exactly how your cash is being held by scrolling all the way down in the Cash tab and clicking on Learn how your cash funds are allocated here. In our case, the entire 32,076 euro balance is being held at Deutsche Bank right now. Before we move on, you can find my links to my 2 favorite brokers, including Trade Republic, down below in the description, which is a great way to support me if you'd like to. Alright, now let's look at option number 2. Euro money market ETFs. These have understandably grown a lot in popularity ever since the ECB started offering higher interest rates in 2023. And they can be a great simple alternative to anyone that doesn't have access to offers like Trade Republic. For example, if you don't live in one of the 17 Eurozone countries they're active in. In fact, the most often mentioned ETF in this segment, the Xtrackers Euro Overnight Rate Swap, aka XEON, has now grown to over 16 billion euros in assets under management. It aims to closely track the performance of the euro short-term rate plus 8.5 basis points, so its yield is close to 2.2% right now if you take its total expense ratio of 0.1% into account. It is a synthetic ETF though, which means it uses swap contracts with large financial institutions, right now 100% Deutsche Bank, but it can also use Barclays, Goldman Sachs, JP Morgan or Societe Generale to generate the euro short-term rate return. Since this introduces some counterparty risk, it physically holds a substitute basket made up of low-risk bonds as collateral, which can instantly be sold to protect investors in case any of its swap counterparties were to go bankrupt. Another lesser-known money market fund that could be worth considering is the Amundi Smart Overnight Return ETF. It is also swap-based and has the same expense ratio, but it managed to slightly outperform the Xtrackers ETF by 0.41% since September 2022. It also uses swap contracts with large financial institutions to mirror the euro short-term rate, in this case Societe Generale, Crédit Agricole, BNP Paribas and JP Morgan. The one notable difference compared to the Xtrackers money market fund is that it uses stocks instead of bonds as collateral in its substitute basket. Luckily, we're talking about large, highly liquid stocks here, but this could nonetheless introduce slightly more risk compared to Xtrackers in a worst-case scenario. For example, if one of its counterparties were to default on its obligations while the stock market is crashing. So just be aware of the difference. One thing I need to mention in this context is that if you're based in Austria like me, I would avoid synthetic swap-based ETFs like these for tax reasons. You can find out more in my video about taxes on ETFs in 22 European countries if you haven't seen it yet. Next, let's look at two physical money market ETFs which get their performance directly from the short-term securities they hold, not from swap contracts. The iShares Euro Cash ETF was launched in November and has already grown to an AUM of 470 million euros. It aims to provide a return in line with euro money market rates, meaning the short-term deposit rate, which it has been doing successfully when comparing its performance so far to the Xtrackers Overnight Rate ETF. It does this by holding high credit quality fixed income securities and short-term money market instruments. The Invesco Euro Cash 3 months, which only holds Eurozone government bills with short durations, could also be an interesting alternative, as long as you're aware that its fund size is quite small at only 130 million euros, which may result in slightly higher spreads when buying and selling. Now, there is a third option I've seen some people mention: USD savings accounts and money market funds. I get why you may be looking at these. After all, short-term rates on US dollars are still quite a bit higher at around 4.25% per year right now. But interest rates aren't the only thing you should be looking at here, as you're exposing yourself to currency exchange risk when you're holding your savings in a different currency. Let's, for example, assume you have 10,000 euros in cash you'd like to hold on to while earning interest, and you pick a US money market fund or USD savings account to do that. Based on the current exchange rate, 1 euro is worth $1.138, so after converting your money, you now have $11,382. Assuming a 4% interest rate, your $11,382 have now grown to $11,837 a year later. However, as you now need this money and convert it back to euros, you realize that the euro has gained 6% in value against the dollar and the current exchange rate is now $1.206 per euro. All of a sudden, what looked like a smart decision at the start due to the higher interest rate actually ended up costing you money, as your $11,837 are suddenly only worth 9,815 euros when converted back into euros, resulting in a 185 euro loss. Of course, the opposite can also happen when the euro loses value against the dollar, something that also happens frequently. In fact, this happened 7 out of the last 10 years, while in 2025 the euro is up 10% against the US dollar so far. Since there's no way to successfully predict which direction exchange rates are going to move in the short term, I personally wouldn't do this with the money you're planning to spend in your future or your emergency fund. Okay, but what about bonds? In my personal experience, buying individual bonds can be a bit of a hassle, as it's not always that easy to properly calculate the yield you're going to get after withholding taxes. However, ETFs covering euro-denominated government bonds issued by countries with good credit ratings could be a worthwhile alternative to money market funds. For example, something like the Xtrackers Germany government bond 0 to 1 year ETF. Its returns are likely to slightly lag behind the short-term ECB rate, but it's likely one of the safest options out there. I would personally not go for durations longer than a year, as that introduces duration risk, which means the value of your bond ETF could fluctuate a lot as interest rates go up or down. To better understand what I mean, have a look at the iShares Core Euro Government Bond ETF and its performance over the past 5 years. Now, ETFs covering short-term corporate bonds could be an interesting option as well, as they tend to come with yields that are slightly above the short-term ECB rate. For example, the iShares Euro Ultra Short Bond ETF, which invests in euro-denominated investment-grade short maturity corporate bonds. As you can see here, it historically performed a bit better than the Xtrackers Euro Money Market Fund. But you should be aware that corporate bonds carry slightly higher risk, which is why this ETF is in the second lowest risk category and not the first like the other ETFs I mentioned so far. Okay, so which option is ultimately the best? Sadly, I can't answer that for you. That's for you to decide, just like with ETFs covering the stock market. For me personally, Trade Republic still represents the easiest and most flexible option to earn interest on any cash I'm not planning to invest in the stock market and exposed to investment risk, while offering a high degree of security by being a strictly regulated German bank and broker. So for me, they're still worth choosing, that hasn't changed. But you may prefer something else, either because they're not available in your home country, or because you like picking money market ETFs or bonds yourself, perhaps using another broker you prefer. That's perfectly fine as well. Those are excellent alternatives to earn interest on your savings. This is simply what my wife and I decided works best for us in Austria right now. Just please keep one thing in mind. If this money is meant to be your emergency fund or for a large upcoming expense like a wedding or a house in the next 1 to 3 years, then make sure you're not taking on investment or currency exchange risks with it, meaning stick to insured bank deposits, money market ETFs, or short-term government bonds with good ratings in your home currency, instead of going further out the risk curve. For this part of your portfolio, capital preservation should be your top priority. You can live out your desire for higher long-term returns in the risky part of your portfolio, for example via ETFs covering the stock market. And be wary whenever you see offers above the current ECB rate. That usually means you're either taking on more risk without being aware of it, or that the broker itself is taking on risk by paying the difference to the ECB rate out of pocket. Something I already mentioned when I looked at the Cyprus-based trading 212 in my broker comparison video, which I'll link below. By the way, you can find my favorite low-cost brokers in Europe, including Trade Republic, down below in the description, which is a great way to support me if you'd like to. I also added all the ETFs I mentioned and their tickers there in case you'd like to take a closer look at any of them. And if you're interested in my entire investment journey from 2017 until today, including plenty of silly mistakes I made, you're going to love this video right here. As usual, none of what I mentioned today was meant as investment advice. I'm just sharing my personal opinion based on my own experience so far. Thank you guys so much for watching. Have a wonderful day, and until next time.